Hello and welcome to this week's Ferrari Financial Market News Summary. Well, the week on Wall Street went pretty well as we predicted last week, with an attempt at some recovery, especially on Wednesday and Thursday, when the market was trying to recapture some of the losses of the previous 10 days. But I'm afraid on Friday, a large sell-off towards the end of the day really underscored the market sentiment at the moment. The prime catalysts, of course, still being the subprime mortgage problems, but of course the market's now feeling this is spilling over into the general mortgage area and the corporate lending area as well, which could influence leveraged buyouts in the future, which has really underpinned the buoyant market for the last few months. Further deterioration in the US housing market is not helping, of course, and until sentiment really changes on that front, the whole feeling at the moment is quite depressed. There was the inevitable flight from equities to treasuries this week, and by the end of the week, the yield on the Treasury note dropped to 4.75 this Friday, as opposed to 4.95 last Friday. So quite a shift in sentiment away from equities this week. Now let's have a look at the chart. Rather than just concentrate on this week's chart, I really want to still look at the 3-year chart for the Nasdaq Composite Index, because this of course is the action this week, and I think you can see here the very steep drop down to the short-term moving average. Why I want to show you it on a 3-year chart is because there's two trend lines I want to draw in here for you today. First of all, the short-term trend line, which is really the last 9 months or so. If I draw that in here, starting at the bottom, crossing the low we saw in February, March, and then ending really just underneath the action of this week, you can see that if it is going to be a short-term correction, we've still possibly got another nearly 100 points for the Nasdaq to drop before it will really hit that short-term trend line and hopefully get a bounce off of that. The more worrying line that I want to show you is in fact the much longer term trend line, which extends back over the 3 or 4 years, which is really more in this sort of area. And really, if I were to lock that in at that point, you can see that there could be in fact a much larger worsening picture developing for the market, because really a shoulder may form at around about this area here, but in fact before this sell-off or this head and shoulders pattern is completely through, we could see a deterioration right back down to 2,300 or even as low as 2,200 for the Nasdaq towards the end of the year. We hope this is not obviously the scenario that will unfold. We hope this is in fact just a short-term correction, but events will have to unfold in the next month or so before we're really sure which scenario is going to be in place. So there was a little bit of an attempt at consolidation this week, but by the end of the week that had really failed, and the market closed at its lowest level. But we do feel that consolidation efforts will continue amidst quite a lot of volatility and continued high volume, and this could continue for some time while the beginnings of a right shoulder in our head and shoulders scenario is forming. We really need some reversal and a rally to take us up possibly 100 points in the Nasdaq to form that right shoulder, and this may take a couple of weeks or even longer to occur. The 2,500 level for the Nasdaq should be some sort of psychological barrier, but if the market penetrates that in the next week or two sharply on the downside, then all bets are off really, because this could be developing into something more of a panic. We'll be keeping a close watch on the markets this week to see which way it moves. So until next week's market summary, it's goodbye from London.